Welcome, everyone. We've got Life After Work today, how to create a good life in retirement. I'm Thomas Manley with Hobbs Group Advisors, and I'm excited today to share with you some insights and information we've learned about retirement income planning. If you're here, it means you're probably, looking ahead to retirement and wondering how you're going to replace your income when the time comes, and how to kind of meet your expenses after your paychecks stop. You've probably got some savings, but you do want to make sure that those are at a level good enough to support you through your golden years. So that's what we're going to kind of dive into. I've got an agenda here. We'll kind of see. It might take 15 minutes, it might take 30, but we want to talk about how you manage your funds so that they can generate the income you'll need. Basic guidelines, is what we'll cover, but we'll go through that today. And then if you have any questions, please feel free to submit those or get with us and we can, take a deeper dive. It's called Life After Work because retirement income planning is a lot. It's really centralized around creating, a good life for yourself after you leave your primary job. So it doesn't necessarily mean, that you won't work. In fact, a lot of baby boomers and that generation that's in retirement or approaching retirement right now, they're still planning to work in some capacity, part-time. A lot of people want that next purpose or that next thing so that they have another sense of purpose to their life, whether it's doing something with family or hobbies, whatever it may be. You want to have something to do, and that might help with kind of the apprehension of leaving your job. But if you don't want to work in retirement, hopefully you don't have to, and that's what retirement income planning can help illustrate. You don't want to get away from how you want to move forward in life, and if part-time job or if work is kind of detracting from that, then you want to make sure you have a strategy so that you can do what you want. So like anything else, you'll need to figure out how to fund your life. You need a budget. We're talking about 30 years here. You're responsible for creating your own paycheck. Until now, somebody else has just kind of doled the money out to you, had taxes withheld, and given the length of time, that's where having that income plan in place gives you the framework that you can follow, adapt, whatever it needs to do for you. And working with an advisor, helps kind of take some of that stress and really just give you a little bit more confidence in your plan and the execution of it. So topics covered, how do you measure up, picturing yourself in retirement, identifying all the sources of income, determining your withdrawal strategy, not skimping on taxes. We don't want to pay taxes, but we do want to make sure that that they're being considered and optimized as best. That's where we integrate with our CPA firm because for retirees, if they're taking required minimum distributions from IRAs, if they maybe don't need those funds, what's the best way to distribute those? Sometimes it's to charities through qualified charitable distributions. We might touch on the case study. We're going to send this to everyone. This is going to be available. So if you'd like to dive deeper on a case study, that's going to be there. And how to get started, right? So it's all just getting the conversation going and making sure that you are prepared to start having that conversation. Let me see. So we'll go to the next slide here. What does a retirement income plan do for you? It's going to help you determine how much income you'll need in retirement, where that income will come from, and how you'll manage that over a 30-year period. As far as one of the biggest risks to a person in retirement is it's outliving your money, right? So you want to plan to an age that might be, a little bit further out than what you might be thinking. Longevity and family history, those are all factors for consideration. But when we run a plan, just as a baseline, we're going to plan to 92 for males and 94 for females. Women are wiser than us, and they tend to live a little bit longer. So we want to kind of factor all these things in. But if a client were to come up to me and say, I've got uh, three grandparents who lived into their hundreds, I'd say, well, maybe we need to bump it out a little bit because you've got some great genes there. But again, it's case by case. And then as far as expected and annual retirement income sources, the expectation is different than the actual, right? A lot of people think that Social Security is gonna do it all for them in their 401k and their personal savings, their IRA, and then maybe a part-time job. What actually ends up paying for most people's retirement is Social Security and personal savings. Pensions or defined benefit plans are few and far between. You see that comes up, with about half of people. A lot of plans, a lot of employers these days do not offer pensions. They were very popular years ago, and now most companies have a 401k plan with profit sharing, but they do not offer a cash balance or pension plan because they're very expensive to maintain for the business. Obviously, paying employees through retirement, through a qualified plan like that, it's just not so favorable for the employee, but they do exist. So if you do come across one, it's always worth analyzing that benefit when it comes time to either draw a monthly paycheck from it or take it as a lump sum. And that's another conversation we have with clients. All right, moving on. So how does your planning measure up? Third of Americans don't have retirement savings. How many of y'all are contributing to a 401k plan? I bet a lot of people are. And that's a great way to just automate your savings within those retirement plans. Those 50 years and older can contribute a little bit more as a catch-up contribution. A lot of people think they're behind on their retirement savings, but you would be surprised because just the time that you have until retirement and then the time you have to remain invested in retirement, even with a modest amount coming out on an annual basis or monthly basis, these funds will last. It's not as easy as, well, I have $1 million and I spend 100,000 a year. That's 10 years. What am I going to do? $1 million, managed effectively with a good withdrawal rate. And even if there's ways to convert some of those assets to even better tax efficient accounts, will last a long time. I mean, that's more than a 10-year bucket for most. So again, very individualized advice there, but it's not as easy as total asset number divided by annual spend equals amount of years you can survive in retirement. So something to consider. Let's see. Let's imagine our life, right? A lot of financial planning, a lot of retirement planning is, what do you want to do? Where do you want to be? Because those kind of goals for yourself drive bigger financial decisions that, impact your bottom line and impact your lifestyle. So if living at the beach is important, I mean, if you want to, potentially buy a more expensive piece of real estate in retirement, but you don't want to have a mortgage, well, you better have the assets to support it. I mean, there's a lot of factors there, and that's, maybe an extreme example, but there's a lot of different ways to kind of cut it up and see, how am I going to make my monthly income that per my retirement plan last my life, but still accomplish those things that I want to do that will cost me on a monthly basis. So budgeting and goal planning are gonna happen side by side and be really important in this process. So the other factor is, what surprises do I think lie ahead? Most of us can imagine, later in life, needing to spend a lot of money on medicine, medical expenses, whatever it may be. We know that healthcare is expensive. We know that the government is going to help out when we turn 65, but it's not free, and it's not going to cover all the bases. So that comes back to tax planning, making sure that you're getting everything you need when you are kind of electing Medicare and going through that process. We're gonna work with you to make sure you're not being over or undersold, and that we're managing kind of your tax with your CPA to ensure you're not paying any additional premium or surcharge, things like that. So um, surprises also, for couples. I mean, if you have a lot of daughters, you know that you're going to have wedding expenses. That's something that you might be in your 60s and your child might be in their late 20s or 30s, and those are little bombs that are going to drop. So things to think about. College, hopefully, you're out of those years, but there could be additional funds needed for family. And weddings are really typical, but you never know. You might have a loved one that needs some assistance, and that might put a strain on your individual finance or your family's finance. So um, just examples, what do you do? What surprises does life hold? How much income we need? Comes back to budgeting and just being very thoughtful and revisiting things annually. That's why our job isn't just a one and done deal. We want to work with you ongoing because um, you never know when that thing's going to happen, but when it does, and we support you through that, you're going to feel really good about all the work that you've done and that we've done together to prepare you for that and kind of weather that. So let's move on through. I think that affordability is really important, and being in South Carolina, I just saw a ranking. I think we were about 15th out of the 50 states, 15th or 16th. And the same goes for North Carolina, similar. A lot of things are based on healthcare, quality of life, obviously, housing costs, things like that. But South Carolina ranked highly, and to be in, let's say, the top third is good. And we all know Florida's up there because people flock to Florida. But think about where your family is. Think about where you want to be, and it might be right where you've been. But your children might have moved across the country, and you want to set up shop close to them so that you can be part of your grandchildren's kind of upbringing or whatever it may be. These are the factors at play, right? So family, healthcare, climate. That's why sunny Florida is important, but South Carolina's got a great coastline, and I think that Hilton Head in that area is very popular. So not a real estate agent, but just thinking about that study that I looked at, I'd be happy to share that as well. So let's see. Next one, how much will you need? As far as home goes, will you downsize? My parents are going through this right now, and it's kind of an interesting time for real estate. So think about, the stress that it might create to move and the value that you're creating as far as, putting some more money in the bank from possibly selling the larger house and downsizing to the smaller house, what you might need for some of those surprises down the road. Um, lots of factors, but that is a common trend. The children have flown the coop, and you don't need the big house. You don't need a huge yard. You're kind of preparing to slow down in life, and so a townhome, a patio home, a condo, even something to kind of lessen that burden, so that you can spend your time traveling instead of cutting the grass, something like that. So other factors, but I think a lot of people will kind of punt some of these decisions for now because there are some barriers as far as the housing market, interest rate environment. But we analyze that and we have these conversations and we're comfortable with a lot of these decisions because again, on the other side of this, you don't want to rock the boat too much right when you jump into retirement. It's probably best to settle in and then see what and see and model what these changes would look like before you go jumping into them. So that's kind of putting the emphasis on proactive instead of reactive planning. What will you do? Part-time work, travel, maybe you own a business and you're just going to kind of take a step back and help lead that company, but operate, a little bit less on a day-to-day basis. Again, you're gonna think of these things, right? You're gonna bring these to the conversation and say, well, this is what I'd like to do. This is how I envision me spending my day. Longevity, I mentioned this earlier, but we talk about planning a little bit further out than what we might assume to be our longevity. People are living longer and longer. There's some good tools to estimate your life expectancy, and obviously, the older you get, the better chance you got at going the distance. So as you can see, the curve, it continues to go out, but just it's kind of a morbid thought, but it's essential to a really good retirement plan. Let's see, unexpected events. We touched on that, but we all know surprises can pop up, and how we kind of weather those and how we prepare for those is important, right? So, just be prepared, but we don't want to, kind of always be thinking the worst, because that's just no way to kind of move through life. You want to know where you stand. You want to, maybe earmark some funds for emergencies. You definitely want to have an emergency fund, but as far as emergencies, weddings, maybe, unforeseen expenses, there's always a way to earmark funds for the unexpected. It doesn't have to be, well, this is going to happen, it's going to blow things up. So we kind of talk through that and make a plan, and it's just being prepared. You feel better about what could happen when you know that there's a plan in place. So how much income you'll need? That's a $1 million question, but Social Security for now, is holding up through our high levels of inflation. People were getting a large adjustment to what they were owed. And that's always going to happen on an annual basis. But it did make the argument of waiting for Social Security a little bit more interesting. I believe Peter's going to talk about Social Security and the analysis that goes with that. But it is a major form of retirement income for everyone. So do we think that's going to go away at some point? Probably not. But could they reduce benefits or kind of rework those to favor the Fed's balance sheet? That's a little bit more likely. So these are all the kind of potential sources of income in retirement. What we see the most is Social Security, IRA distributions, or maybe a pension, and then really just creating a regular withdrawal from an investment portfolio. So that could be the IRAs, that could be the brokerage account, whatever it may be, to kind of supplement that Social Security. So, but in identifying, retirement income versus expenses, typically, unless you're making a big move in retirement, your home's paid off, and you're really just covering the bases on essential expenses. If a new car purchase comes along, you're prepared for that. There's not a big debt load later in life, and so you'll find that you're not really having to coordinate all these other assets as much as you might think today to cover what your budget is in retirement. So just moving through. Again, we're just diving into how these different sources of income look, and what that means to you. But you'll have all this. Again, we know where we're going to get our income from, or we have an idea, but that's part of what we model is, what part of the burden do your assets pick up, and provide for. This is just illustrating how Social Security is going to look a lot different on your today statement versus your, age 62 or 64 statement. When you really start to think about what these numbers are going to mean at full retirement age or at the maximum 70, depending on when you take that. But again, this just illustrates how important time is in the overall return of your assets. So just getting a mere 2% for 30 years takes that 2,000 and makes it into $3,600 a month. So that's pretty interesting. Pensions, distribution options is really the big ticket question there, because that's where you'll have to consider an annuity payment on that pension, where the company says, okay, here's your pension, you're going to get $2,000 a month, or you're going to get $500,000 as a lump sum. If you take the $2,000 a month, it's good for your whole life. Or you can take $1,700 a month and it's good for your life and your spouse's life, regardless of whoever passes first. So looking at that and just saying, do I think I can do better, and is this fairly valued? That's kind of pension annuity analysis. Tax implications that come along with that tend to follow just the income tax schedule. But again, CPA and integrating with them, making sure that we're covering all the bases is really important. So let's continue on. These are just examples of typical portfolio accounts, right? So you've got your IRAs, your qualified plans, and then your taxable brokerage accounts. So there's a lot of others. Some of the other useful accounts in retirement, one in particular is an HSA. So, throughout your career and your employment, if you were part of a high deductible health insurance plan and you're able to max out an HSA, which could mean $3,800 a year or close to $8,000 a year, just depending on your age and how many people are covered by that health insurance plan, that becomes a very useful bucket of money in retirement, because it's never taxed again. You got a deduction on the front end, and it can be invested if you're not using those dollars and potentially grow even more and not pay any taxes, so long as it's used for qualified purchases. And there's a lot of different ways to use those monies, and we can always dive in on that with you. Let's see. So other income, if you have these, but you could tap into your home's equity. There are things like reverse mortgages and ways to pull out equity in your home if you do need additional income. Obviously, if you have any income from other ventures or inheritances, trust, etc., those are going to be part of your plan. So determining your withdrawal strategy, it comes down to having that budget in mind, having those goals in mind, and then really running a Monte Carlo or another kind of analysis that's just going to create thousands of different scenarios where we say the market's going to do this or this, whatever it may be, and poor timing as far as, I retired and then the market tanked and we're in a recession. What does that mean for the next 29 years of my retirement? Creating a strategy if things aren't so rosy on the other side of that analysis. How can we make it work with no additional fund, no additional money going in? Or, how do we maybe continue to work a little bit longer, put some more away for ourselves, postponing retirement and building savings so that we can live the exact life we want, or dialing things back so that we can retire today and have what we need. So it's always fluid. It's always what's the best option for you that can be supported by your assets. Living off the interest. So long time investors love blue chip stocks because they pay a good dividend yield. Right now, it's kind of hard to beat money market rates. They're at 5%. A lot of dividend yields, are in that single digit range, but there are underlying risk to having a lot of money in one company. If you own $1 million worth of Coca-Cola, you've probably got a pretty good dividend yield or income from that stock, and you own the company. But if something happens to Coca-Cola, it could really impact your overall net worth. So, having a good strategy if you are intending to live off interest in a portfolio, just making sure it's well diversified. Bonds are another great way. If you've got high income in retirement, municipal income is a great way to reduce your taxable or your tax bill, I'll say. A lot of what we do in fixed income for our clients is just make sure that we can get the most interest in a tax efficient manner. And a lot of the time that looks like municipal fixed income, municipal bonds. So and with fixed income, you don't necessarily have to buy individual bonds or master limited partnerships, whatever you may have heard. There's a lot of ways, especially now, to invest in exchange traded funds, which are similar to mutual funds and mutual funds that provide bond interest and municipal bond interest. So it doesn't have to be so concentrated. It can be very diversified. Let's see, 4% rule. Probably heard of this. If you take 4% out of your account, you're not going to outlive the money. You're rarely going to tap into principal if you just take out 4%. Rules of thumb are good conceptually, but in practice, you should live by your own rules. You should really know where you stand and where your portfolio stands, and have a very personalized plan. Not, well, as long as I take 4%, I'm covered. So that's what we say. But it's not a bad consideration. Another one of those is well, my first year RMD is going to be about 3%. So there's a lot of ways to kind of think of what retirement's going to look like and what amount you could take out and what amount you might receive. But it's really good to have firm numbers and plan for those. So let's see, bucket strategy. So bucket strategy is good. And if you are in the spend stage of life and you're not contributing to your assets anymore, but rather drawing them down, you want to, one, take from your tax efficient buckets, qualified retirement, Roth, brokerage, after tax savings, all of that. You've got to kind of orchestrate that, right? And then within the portfolio, you've got to stagger your investments shorter term to long term. And that's really the bucket strategy. So you've got your next year of spending set aside in a money market or something very short term because you can't weather the storm. The account balance can't go up and down on you. You need it to be rock solid because you're depending on those dollars. The next few years worth, well, those can be, a little bit kind of intermediate term, maybe CDs, maybe bond funds, maybe some dividend paying stocks, something that's conservative enough, but not cash. And then, the next bucket out, that could be more growth oriented, right? Because that's the bucket that's going to appreciate and refill the earlier term buckets, the short term and the kind of medium intermediate term bucket. So that's what a bucket strategy kind of looks like or feels like. But again, everybody doesn't fit the same mold. So you should have a short-term bucket because you can't have the stock market cost you more than you need to take out of your portfolio. But there's a thoughtful way to do it all. So let's keep going. Mandatory versus discretionary. This is budgeting. And so, this is something to think about, but it is not the end all here. Obviously, you need to cover your needs before your wants. And I think a lot of people understand that. So we'll move on. Pros and cons. I think that these are all useful strategies, and we would support a lot of these. I don't love uh, using rule of thumbs, to kind of predict inflation. We've seen that has kind of flopped. Bucket strategy is definitely useful. Mandatory versus discretionary, just having a good budget. I think, this is really focused on using your fixed income to cover your needs and your variable to cover your wants. Living off the interest is one way to kind of, again, live within your means, but there's pros and cons to all of them, and we're here to discuss them with you. Taxes, I keep mentioning as we go through this, we share walls with the CPA firm, so it's like osmosis in here, but it's really important, and we try to put an emphasis on that because you shouldn't pay a lot of tax. But for some, it's a problem, and we really put an emphasis on that in the planning process because it's more money in your pocket and less in the government. So we think that's very important. Let's see. This is just going to kind of cover how your income in retirement is taxed. Obviously, you wait till full retirement age on your Social Security, and you're going to be pretty well covered. But again, we can talk about capital gains rate versus interest income and other assets, but working with your CPA, working with your financial advisor, you're going to get a lot of these rates uncovered, but they're always changing, right? So, one thing to think about today before retirement is, well, how can I protect myself? How can I kind of de-risk my tax situation? And that could look like Roth conversions in your transitional years or your gap years where you don't quite collect Social Security and you don't quite have a paycheck, so your income's very low. Well, let's convert some pre-tax IRA money to after-tax money and eliminate that tax bill down the road, and ultimately for your heirs, because that's a great asset to inherit, is a Roth IRA where they're not going to pay taxes on it, and they've got a decent amount of time to get that withdrawn, and they can convert it to brokerage assets for themselves. So how it's taxed, kind of go on from that slide, but very important because income tax rates are higher than gains, and then your Social Security, and your pensions could have some excluded, depending on when everything's elected. So tax planning strategies. I'm jumping ahead on slides. I just mentioned Roth conversions and gap years, delaying Social Security. Those are really the big ones, right? So we kind of lead with those and then drill down into how that works. But this is just going to give an example of what accounts to tax first, or what accounts to kind of dip into, whether it's through kind of your bucket strategy or just your retirement income plan. You go for that after tax, that brokerage account money, then you go to your tax deferred, your qualified retirement, and then you go into that tax-free, that Roth, because that bucket is so useful that you would rather, pay a little bit of tax on the others before you tap into that one, because it's going to continue to grow. The longer you give that time to grow and create, generate return for you, the bigger that bucket gets, and then you might be in a situation where maybe you've exhausted the majority of your other assets, but you're left with tax-free money, and your final bucket is tax-free, and you never have to worry about taxes with regards to taking money out of that account again. So, how do you get started, right? So, you've got all this information. You see this face, you love this face, and we appreciate you coming by and kind of if you stuck through this whole thing. I said 15 to 30 minutes. We're coming up on the 40-minute mark, but um, get with us. Come up with an action plan, gather your stuff together, make a list of questions, and then get with us, make an appointment. We're happy to have a call. However you want to engage us, we're happy to kind of show you how we work for clients and the value we provide. But again, financial planning and then executing on the retirement plan that's created is what we've had a lot of success with and helped our clients be really successful with. So give us a call, let us know. I appreciate everyone's time today. And if you do have any questions, because this wasn't live, you are welcome to email me or the firm, and all our contact information will also be attached to a lot of this. So thank you all. Have a great one.